Hey everyone, Weston Nakamura from Real Vision in Tokyo. I'm here with another personal takeaway on a Real Vision video on the topic of recession. And this one is with Jeff Moore from Fidelity and Raoul Pal on the topic of fixed income. Now, what's so great about this particular video? So, this is what I would consider classic Real Vision. Okay, so I've been a Real Vision subscriber for, I don't even know how long at this point, a couple of years. And so what I mean by that is that this is a look at a real, genuinely real conversation amongst institutional capital that we get to be a fly on the wall for. So this is Raoul, who is an actual investor slash trader, who is trying to collect market color in a specific market or an asset class. In this case, it's bond markets, by talking to a peer with a specialty in that field or in that market. So that Raoul can basically distill all this info together and make portfolio management decisions. So this isn't Raoul just asking questions to an expert and is doing so for the sake of the audience, but already knows the answers to. Okay, which by the way, that's never really the case ever with these interviews with Raoul. But say that it were, right? Who cares for us on the receiving end if it's all new info and insight, all the same for us. But what I mean is that Raoul is behaving as an institutional investor, and this is Raoul acting on his own economic interests for a potential market play, which is if and when and how to execute a long duration trade, a long bond trade. And this video is what he would be doing anyway if he were still a portfolio manager managing discretionary risk at a global macro fund like GLG. And he and Jeff Moore are just allowing their discourse to be recorded for us to see. That's what I mean by classic Real Vision. Okay, so the way that institutional finance behaves, right? This is coming from my own sort of experience. You have, the buy-side investors, you have sell-side, like agencies, the banks, sales, research, and market makers. It's like, why do they talk to, each other, like amongst each other all day with such frequency? What are they in need of talking about, right? Obviously, they don't need to, like, lessons or teach-ins or deep dives. These, like, trade desk like phone calls and like the huge list of like persistent Bloomberg chats between client and broker or between peer traders or portfolio manager, fund managers, like what are those all about, right? So they're doing like basically they're talking about one of three things generally. So first of all, it's what are you seeing or what are you hearing, right? In terms of like flows and activity, or lack thereof, buy and sells, right? Who's doing what? Is it foreign long only money? Is it short covering? Is it opening new longs? What's going on? What are you hearing? The second thing is, what are you looking at in terms of catalysts? If you have a proprietary model, a market price action indicator. So what are you looking at and what are others looking at? And then the third thing is, based on all of that and based on where markets currently are and how they got to where they are, what's your view going forward from now? And regardless of whether you're like a directional shorter term, like, Paul Tudor Jones type of trader or a long-term, long-only investor, everyone basically wants and needs to know the immediate to near-term view. And then, a few months out, maybe 6 to 12 months out, and then maybe a very long-term view if it does get to that. And by view, I don't mean just like a market up or down sort of answer. It's like market behavior and kind of specific timelines in which they're thinking about things. And so this is what Raoul and Jeff are discussing. Raoul seriously reminds me of a client call with his questions, because he's genuinely asking. Because he wants to know, because he was trying to trade this long bond position. And he's asking exactly the type of questions that I would be asking if I were him, or that I'd be expected to be asked on the sell side. So again, we need to look and analyze the discussion from that angle of, this buy side fund manager looking to go long duration, which is Raoul. And he's trying to figure out when and how to pull the trigger and where the risks are. And so he's calling up an old trusty go-to veteran specialist that he regards as highly credible, based on existing relationship history. So first of all, who is this guy Jeff, and what's his background? Why is Raoul talking to him of all people regarding the bond market as a whole? Jeff is a portfolio manager and has been so for decades at one shop, Fidelity. Fidelity is, as you all know, a massive, massive asset manager, but most people associate Fidelity with like bottom-up fundamental stock picking and research, right? And for the most part it is, but they also have a massive fixed income division for which Jeff helped build basically from nothing. And the fact that he's been there for decades and you've seen many cycles before. Now, Raoul wants to trade against this tide of selling. And this is not just any selling. This is the most ferocious selling we've seen on record. This is the worst quarter. Q1 2022 is the worst quarter we've seen in terms of bond market total returns on record. And so because Raoul's trying to buy duration into this, tidal wave of selling, this historic tidal wave of selling, this is the kind of the steps that he goes through and what he needs, his checklist of things that he needs to, ask Jeff about. So he basically checks in on three key regions, which is the US and the Fed, Japan, and Europe. And I have to say, of these three, they spend the most time on Japan-related talk, be it BOJ, the yen, Japanese outbound fixed income flow, and so on. Right up my alley. So first, the US. Okay, so they don't talk about the Fed much during this conversation, like relative to how much the rest of us pore over and obsess over the Fed. Why? Because it's frankly a waste of time. Like, they both know there's inflation and that the Fed is behind the curve and that they are tightening. But really, it's not worth poring over because Raoul, who has expressed this before in his most recent, super comprehensive keynote video on recession, he reiterates this point that the markets have already done the Fed's work of like tightening, especially in the bond markets, or the lifting of yields for them already, and therefore the Fed is relatively irrelevant.
It feels that the bond market did the tightening for the Fed.
Yes.
And that the Fed is kind of irrelevant at this point because the bond market did it all.
And then Jeff, he not only agrees, but he explains why the Fed is irrelevant, and that the Fed has, and J. Powell has essentially purposely made themselves irrelevant to markets. And he uses this hilariously apt analogy of Powell being a bad doctor.
You've heard this notion of R-star, right? What's the neutral rate? I don't think he knows. So he's kind of a little bit like a bad doctor right now. He doesn't really know. So he keeps squeezing us. Does that hurt? Does that really hurt? How about that?
Okay, so according to Jeff and Raoul's belief, the Fed is being led by markets. So you don't really need to look at the Fed. You just need to look at markets because that's what the Fed is following. That's what the Fed is looking at. If you're looking at the Fed, you're looking at a second derivative. You could just be looking at the markets themselves. Jeff is basically trying to look for a turning point in the Goldman Financial Index once it breaks into the 101 level, okay, because that is essentially where then Fed Chair Yellen was able to, be at kind of max hawkish or max, tight financial conditions before blowing China up and having a PBOC deval in 2015. So that's kind of where he sees his threshold. The one thing I would push back on that to Jeff is that, yes, but they're not seeing an 8 handle on CPI at that time. So I don't know if the Fed put is something that you can put at like where things were in 2015. So therein lies the difference. But look, at the end of the day, what do I know relative to him? And then finally, Japan, which again, Raoul hits the exact right questions, and I gotta say, Jeff knows what's going on and what to look for. So first and foremost, there isn't any question about BOJ and Japanese investors' influence on US and global yield picture, which I often encounter. Like the skepticism of the influence that Japan has on, the global fixed income market. People seem to think that I overemphasize Japan's influence on global bond markets and therefore global risk markets because of some geographic bias because I'm based in Tokyo. I've said this time and again, it has nothing to do with anything. If I were in Norway, I would still be looking at the BOJ. But now, here you have a Canadian national working at an American global asset manager based in New Hampshire talking to a British global macro investor in the Cayman Islands. And they're focused on Japan. So it's not me, okay? So with Japan, Raoul asked Jeff about the Bank of Japan, yield curve control, and their sort of recently announced forever fixed rate JGB buying operations to pin the 10-year yield at 25 basis points, being the only major central bank printing money into an inflationary cycle. And it echoes what I've been discussing, several times over the last several months. So Jeff is indeed looking at BOJ, but he's looking at BOJ through the same sort of time lens that I am, which is Governor Kuroda entering his final year of his unprecedented second term as the longest tenure in BOJ history, coming to a close. And that's how he kind of compartmentalizes like eras and timeframes. And just like me, he thinks there will be a policy change or like a new policy framework that comes with Kuroda's exit and his successor, new tenure. And so what that policy framework will look like, that will depend on obviously the markets at the time, but it'll also depend on the upper house elections this summer, which is what Jeff is very aware of and what he points out. And that will help to influence who Kuroda's successor will be. And until then, BOJ will keep rates capped at 25 basis points. Now, Jeff actually uses an analogy that I've used before regarding George Soros and the Bank of England. He uses it in the context of the ECB, but also with BOJ as well. But here's the clip.
Now, remember this, though. The ECB as a whole has a current account surplus.
That's right.
So it's still what I call in its own control. It can do what it wants. It doesn't. It's like the yen, the Japanese. They can decide to keep these rates here, and there's nothing we can force them off. This isn't, where George Soros took the British off the ERM ban.
Now, this is a good opportunity for me to clarify, okay? When I say that this as in the BOJ could be a Soros versus Bank of England type of situation, I don't mean in terms of the mechanics. This is not the situation. BOJ has an unlimited printing press with a current account surplus. So, at the expense of the yen, JGBs cannot mechanically break through that 25 basis point level. The Bank of Japan can hold 25 basis points on a mechanical, technical level. Okay, what I mean by Soros breaking the Bank of England type of moment for BOJ is that markets, via the currency market, can potentially force BOJ to loosen their grip on the 25 basis point cap of JGBs in the face of exploding sovereign yields. But theoretically, BOJ can keep JGB 10s at 25 basis points, even if that means they've absorbed every last JGB trading in the secondary market and dollar yen is at like 300. That's what I mean. Now, speaking of dollar yen at 300, they talk about the yen in several contexts. They don't say dollar yen's going to 300, by the way. But the 2 points to highlight regarding the yen is the hedging cost for Japanese investors to U.S. Treasuries. And the second point that Jeff comes back to frequently is the current account surplus. So on hedging costs. So there's quite a discussion out there about how FX hedging costs for Japanese investors are getting astronomically high, and that's what's preventing Japan buyers from buying treasuries as they would normally do, but they're refraining from doing in 2022. And I've argued that while this may be the case for some, there are plenty of Japanese buyers who can and will buy U.S. treasuries unhedged. And when Jeff addresses this buying of, Japan buying of U.S. treasuries, he basically says that the question isn't whether or not Japan is or isn't buying U.S. treasuries. They are. The behavior hasn't changed. The question is whether or not they're doing it hedged or not. But the behavior and the usual flow hasn't really changed, even if it's delayed at the moment. So that's a critical sort of point number one. And then the second point, on Japan's current account surplus. He seems to put a lot of faith in the yen not getting destroyed to like 150 plus because of Japan's current account surplus. And I would say true. However, that surplus is not like a guaranteed thing. It is in danger of whittling away. And if it goes, so goes the yen. We've seen 2 months of deficit prints this year. So it isn't like, it isn't a definite thing. Japan still has the largest net international investment position. But in terms of like balance of trade, Japan is importing energy at ever higher costs and exporting less and less. So it's something to keep an eye on. Japan does not have a guaranteed sort of surplus and therefore a do whatever they want to with the yen sort of scenario. But for now they do. And that's sort of Jeff's kind of framework. And then finally, after covering, the major central banks, the inflation outlook, the currency angle, the state of global flows, particularly from Japan, Raoul, once again, as an institutional investor, asks what the current state of positioning is. In other words, everybody hates bonds. Bond markets sold off at, record ferocious pace. How underweight are bond market investors? This is what he wants to know. And just like, a real conversation of this nature would go, Jeff shares two sort of anecdotal stories that are obviously going to be anonymous, but he says like, well, I was just speaking to client XYZ who is this sort of like long only and they are X amount funded. And this is what they're asking me, or this is what they're looking at. And then here I have another client who's this. And so, like, this is what I mean. This is classic Real Vision. This is what conversations more or less look like. This is not theater. This is both people on both sides with real capital at risk doing what money managers do. They talk to each other, then they talk to others about what they talk to each other about. But in this case, we got to get a peek into one of these real conversations. So, save this video in your archives. This is not just for the immediate, information, but this is to rewatch later and observe how the discourse goes in institutional land. And obviously, this is not the only video on Real Vision that is like this, but for me personally, even though Jeff has basically confirmed everything that I've been saying about BOJ and things that I've been watching, it's still incredibly valuable to me, too, because, A, it lets me know that indeed I'm not overweight in my focus on things like BOJ and Japan, and that my path of attention isn't veering off into the wilderness. And B, it also lets me know that others like him are indeed very much also aware and are watching right alongside as well. So, fantastic job for both Jeff and for Raoul. This is my favorite video so far in the Recession series. Thanks to you guys for watching. We'll see you for the next one. Thanks. Bye.